Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamoan, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions.
This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their homeownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode. Today we're discussing some alarming trends in Ontario's mortgage landscape. According to Equifax Canada, the province's mortgage delinquency rate has reached record highs, marking a significant year-over-year spike. Steve, what are your thoughts on these numbers?
Well, Janine, the data is quite concerning. The 90-plus day mortgage delinquency rate in Ontario surged by 71.5% from the same period last year, reaching 0.24%, the highest increase among all Canadian provinces. This indicates substantial financial stress among consumers.
It's certainly alarming. And it seems that this isn't just an isolated issue. British Columbia also saw a significant increase, though not as high as Ontario's, with a 33.3% rise. The national average climbed to 0.19%, but Ontario's rate is clearly leading the charge. What's driving this surge, Steve?
Equifax points to the so-called Great Renewal, where many pandemic-era mortgages are coming due for renegotiation. This has led to a 57.7% jump in new mortgage originations year over year, largely driven by renewals and refinancing, especially in Ontario, Alberta, and British Columbia.
So, while some homeowners are finding relief through refinancing, it seems not everyone is benefiting. The affordability challenges remain significant.
Exactly, Janine. Rebecca Oakes from Equifax Canada noted that even though some homeowners are navigating the refinancing environment, affordability challenges haven't eased for everyone. It's a complex situation.
And it's not just mortgages. Missed payments have climbed across various credit products. More than 1.4 million Canadians missed at least one credit payment in the first quarter, with non-mortgage delinquencies up by 8.9%. and mortgage delinquencies rising 6.5%.
Ontario's non-mortgage delinquency rate is especially concerning, surging by 24%, the highest in Canada. Alberta and Quebec have also seen increases, but Ontario's numbers are particularly striking.
Younger Canadians seem to be facing the brunt of these financial challenges, with the 18 to 25 age group experiencing a significant jump in delinquency rates. It's a tough time for many in our community.
Yes, the younger demographic is struggling. Their 90-plus day credit card delinquency rate hit 5.38%, up 21.7% year over year, and auto loan delinquencies rose 30% to 1.95%, compared to the national average of 1.08%.
It's clear that the economic pressures are impacting spending behaviors, with credit card spending slowing and payment levels dropping. Consumers, especially younger ones, are being more prudent, trying to manage their finances carefully. As we continue our discussion on the current state of the mortgage market, it appears that Canadian borrowers and brokers shouldn't expect a significant drop in mortgage rates anytime soon. Steve, what's the latest on this front?
That's right, Janine. The situation is quite dynamic, and recent developments in global financial markets have played a significant role. The rising United States debt has caused some fluctuations in bond yields, which in turn has affected lenders' fixed rates. Although we've seen a slight dip in those yields recently, there's still a lot of uncertainty about the future direction of fixed rates.
It's definitely a challenging time for borrowers who are trying to navigate these changes. The uptick in core inflation last month might lead the Bank of Canada to keep its benchmark rate unchanged when they meet next week. This could mean that lenders are hesitant to lower their fixed rates anytime soon.
Exactly. According to Victor Tran from Rates.ca, many lenders are likely to adopt a wait-and-see approach with bond yields as the financial markets anticipate the central bank's decision. They increased their fixed rates last week, and despite the slight decrease in yields, They're in no rush to bring those rates down.
It's a tough situation for homebuyers, especially those on the margins who are hoping to finalize their deals. Even a small increase in fixed rates can have a significant impact on their buying power.
Absolutely. The fixed rate increase of about 10 to 15 basis points may not seem like much, but it can be a deal breaker for many buyers who rely on borrowing the maximum possible. This situation is further complicated by the stress test rates, which have also ticked upwards.
And with affordability being such a critical issue in cities like Vancouver and Toronto, even minor adjustments in lenders' rates can have major repercussions for potential buyers.
That's a good point, Janine. Despite the rise in fixed rates, they still remain popular among borrowers, likely due to the security they offer in such economically turbulent times. Many prefer the certainty of a fixed rate over the potential savings of a variable rate, especially when the market is so unpredictable.
It's understandable. With the ongoing Canada-US trade tensions and stubborn inflation, it's hard to predict how much the Bank of Canada will actually reduce rates this year. Borrowers are looking for stability in an uncertain environment.
Precisely. While there is talk of the Bank of Canada continuing to decrease the overnight rate, it's not expected to be as significant as many had hoped. People seem to be valuing certainty over the gamble of potentially saving more money down the road.
As we dive deeper into the housing market's current state, it seems the sector is under increasing pressure with recession fears looming over Canada. Experts are suggesting that we might already be in a recession, and this could have significant effects on the real estate landscape.
That's right, Janine. Vic Singh, a professor at Toronto Metropolitan University, has likened the situation to being in quicksand. He emphasizes the need for a steady approach to navigate these challenging times. This economic slowdown appears to be prompting property investors to exercise more caution, which could lead to a reduction in discretionary spending on real estate.
It's certainly a time for careful consideration. A recent report from BMO Financial Group indicates that 67% of Canadians are planning to delay home purchases until borrowing costs decrease. Additionally, 70% of Canadians are expressing concerns about a potential recession, which highlights the current atmosphere of financial restraint.
Indeed, Janine. However, Kingsley Ma from Remax Canada sees potential opportunities in this downturn. He points out that lower prices and stable inventory could provide confident buyers with an edge, even though the ongoing US-Canada trade war is stalling broader housing activity.
It's interesting to see that perspective. For mortgage professionals like Kyle Green of the Green Mortgage Group, it's about reassessing operations to adapt to these conditions. He's been maintaining a lean approach, having cut his marketing budget significantly back in 2022. Despite these constraints, Vancouver's market shows some resilience, potentially due to its lower reliance on industries affected by tariffs.
Green's approach highlights the necessity of adapting to economic cycles. While first-time buyers are particularly susceptible to market fears, he remains cautiously optimistic. Green believes that potential interest rate cuts could present new opportunities for both mortgage professionals and their clients.
It's reassuring to hear some optimism. Singh notes that the impact of a recession could be more pronounced in metropolitan areas like Toronto, where unemployment trends are higher than the national average. The condo market, already under pressure, might face additional challenges as job losses affect first-time homebuyers.
Yes, the uncertainty in global trade politics, particularly with the US, adds another layer of complexity. Singh humorously suggests that changes in trade relations could happen unpredictably. Despite the challenges, Green sees the current prolonged downturn as an opportunity to strengthen the industry, believing that those who can endure these times will emerge even more resilient.
The recent decision by Ontario to reject Toronto's affordable housing plan has raised eyebrows among many housing advocates. It seems that pushback from real estate investment trusts, or REITs, played a significant role in this outcome. Steve, what can you tell us about the situation?
Well, Janine, Ontario has effectively scrapped Toronto's proposed affordable housing requirements for nearly 70 redevelopment sites across the city. Initially, the plan included affordability mandates, requiring a percentage of new units to be priced below market rates for at least 99 years. But after pressure from major landowners, including several real estate investment trusts, the province replaced those mandates with non-binding language, essentially making affordable housing a suggestion rather than a requirement.
It's concerning to see such a significant shift, especially during a housing crisis. The affordability requirements were meant to ensure that new development served residents across various income levels. But it seems the REITs argued that these mandates could stifle development or make projects financially unviable. What are your thoughts on their concerns?
The REITs, like CT REIT and Choice REIT, claimed that Toronto's requirements were unauthorized and could halt redevelopment projects. They argued that the affordability demands were too steep and might sterilize a site from residential redevelopment, especially for properties with long-term commercial leases. While I understand the need for financial viability, it's crucial to balance that with the community's needs for affordable housing.
Absolutely, Steve. It's a delicate balance. Toronto City Council had approved the land use conversions with clear trade-offs, including minimum affordable housing contributions. These were considered essential to ensure new developments catered to residents across income levels. But the province's decision seems to have shifted that balance without offering a public explanation.
Right, and the timing of this decision is also noteworthy. It came just ahead of Ontario's 2025 election call. Toronto's chief planner Jason Thorne even circulated a memo to elected officials, warning that the province's revision could jeopardize approximately 5,000 affordable units. This decision seems to align with Premier Doug Ford's pro-developer stance, where he emphasizes cutting red tape and regulations to create conditions for companies to build.
It's a challenging situation. While it's important to encourage development, we can't overlook the need for affordable housing, especially in a city like Toronto, where affordability is such a critical issue. As Paul Hess, a planning expert, pointed out, the province has the power to override municipal decisions, but that doesn't necessarily mean it's always in the best interest of the residents.
That's a valid point, Janine. Balancing development and affordability is a complex issue, and while the province aims to build 1.5 million homes by 2031, it's essential that these homes are accessible to people across different income brackets. The situation highlights the ongoing tension between economic goals and social responsibilities, and it's something that will need careful consideration moving forward.
Steve, today we're looking at an interesting development in Canada's financial landscape. Foreign investors are playing an increasingly significant role in Canada's debt market. This shift has been highlighted in a recent report by National Bank's Warren Lovely. What's the situation exactly?
Well, Janine, it's quite a remarkable trend. According to the report, foreign investors absorbed about 60% of all newly issued federal debt during the 2024 to 2025 fiscal year. That's $91 billion worth of Canadian T-bills and bonds purchased by non-residents over 12 months. This level of foreign involvement raises important questions about the dynamics of our national debt and who is essentially supporting Ottawa's borrowing needs.
It's a significant amount, Steve. I understand that foreign investors now own 36% of Canada's outstanding government debt, which is a stark increase from the historical average of 23%. While this influx of foreign capital adds liquidity to our bond market, it also seems to come with its own set of risks.
Exactly. The participation of foreign investors has been beneficial in many ways, especially in providing liquidity and helping finance Canada's growing deficits without overburdening domestic investors. But, as the Bank of Canada noted, there's a risk factor involved. Many of these foreign investors use leverage, and there's always the potential for them to withdraw quickly if market conditions change or if their risk tolerance shifts.
That makes sense, Steve. It's interesting to note that in the first quarter of 2025, foreign investors didn't add any net new federal debt to their portfolios. Domestic investors had to absorb all of Ottawa's new issuance during that period, which was the most since the pandemic borrowing spree of mid-2020. Do you think this pause was a temporary shift?
It does appear to be temporary, Janine. The National Bank report indicates that foreign investors were responsible for about 30% of Government of Canada bond and T-bill trading volumes in April. This suggests that while there was a pause, foreign investors have started to re-engage with the market, even outpacing some domestic banks and institutional clients in recent bond auctions.
It's good to see that foreign interest in Canadian debt remains robust. However, with Ottawa's borrowing expected to rise, especially in the absence of a concrete budget, and with campaign promises hinting at larger deficits, how might this reliance on foreign buyers impact the broader market?
If foreign appetite for Canadian debt wanes or becomes more selective, it could lead to higher bond yields to attract buyers. This would increase the government's borrowing costs and potentially influence fixed mortgage rates and broader financial conditions. As Warren Lovely put it, Ottawa must guard against budgetary complacency. While Canada remains relatively solid compared to some peers, global investors have choices and their expectations can shift.
It's a delicate balance, Steve. While the involvement of foreign investors can be beneficial, it's crucial for Ottawa to maintain a stable fiscal policy to ensure continued interest in its bonds. As always, it's about finding that equilibrium between attracting necessary investment and safeguarding national economic interests. Let's shift our focus to Scotiabank's recent quarterly earnings, where we've seen a notable slowdown in their mortgage growth. This is particularly evident in major housing markets like Toronto and Vancouver. Steve, what's happening with Scotiabank's mortgage originations?
Well, Janine, Scotiabank's mortgage growth has indeed stalled in the second quarter, with average balances remaining flat from the previous quarter. Mortgage originations in the Greater Toronto Area fell to $3.3 billion, down from $4.4 billion in the first quarter. Similarly, in the Greater Vancouver Area, originations declined to $1.7 billion from $2.1 billion.
It's certainly a slowdown, but it's interesting to note that on an annualized basis, their average mortgage volumes were still up by 6%. It seems like Scotiabank is trying to navigate these challenging times with some strategic offerings. What can you tell us about their approach?
That's right, Janine. Scotiabank's Mortgage Plus solution, which bundles a mortgage with other financial products like checking accounts or investments, accounted for 88% of their originations this quarter. This strategy is helping them maintain high mortgage renewal retention rates. Scott Thompson, the president and CEO, expressed optimism about loan growth recovering in the latter half of the year, despite the current softness and uncertainty.
It seems like they're leveraging their bundled offerings to keep clients engaged. Moving forward, fixed-rate mortgage renewals are expected to spike in 2026 and 2027, with a substantial portion of their residential mortgage book maturing during those years. How is Scotiabank preparing for this?
Scotiabank is certainly keeping an eye on those upcoming renewals. Their residential mortgage portfolio totals $305 billion, with a significant chunk due for renewal in 2026 and 2027. They're focusing on maintaining their uninsured loan-to-value ratios, which declined slightly in the second quarter, indicating a cautious approach.
Along with managing their renewals, Scotiabank is also dealing with stable mortgage delinquencies, although their provisions for credit losses have climbed. Steve, what's driving this increase in provisions?
The increase in provisions for credit losses, which rose to $1.4 billion in the second quarter, is largely driven by Canadian banking. This reflects a more cautious stance in the current uncertain macroeconomic environment. Phil Thomas, the chief risk officer, noted that the bank's build in provisions since 2022 is a response to these uncertainties.
Their cautious approach is understandable given the economic backdrop. It's also worth mentioning their exposure to the condo market, which has been a topic of concern lately. However, Scotiabank seems to be managing this risk quite deliberately.
Indeed, Janine, condos represent 20% of Scotiabank's mortgage portfolio, but they've been focusing on Tier 1 developers with experience in navigating down cycles, particularly in major cities. This deliberate strategy helps mitigate some of the risks associated with the condo market, which is currently facing challenges with buyers walking away from pre-construction deals.
It's good to see Scotiabank taking strategic steps to manage their risks while still looking for growth opportunities. As they navigate these times, their approach could serve as a model for other financial institutions facing similar challenges.
Absolutely, Janine. As we wrap up, it's clear that Scotiabank is focusing on maintaining stability and preparing for future growth. Their strategic initiatives and cautious risk management are essential in this uncertain economic climate. Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder, Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time and stay informed with the latest industry insights.